The Detrended Price Oscillator, commonly known as DPO, is a technical analysis indicator with a specific purpose. Unlike most indicators that focus on momentum or trend direction, the DPO is designed to remove the underlying trend in prices. Let's visualize this concept. Here we have a standard price chart showing both trend and cyclical movements. This price data contains both a long-term trend, shown here in red, and short-term cyclical movements. What makes the DPO unique is that it filters out this trend component, allowing traders to focus solely on the cycles. There are three key aspects that differentiate the Detrended Price Oscillator. First, it effectively removes the trend component from price data, allowing traders to see pure cycles. Second, unlike RSI or MACD, the DPO is not primarily a momentum indicator. Its purpose is to identify cycles. Third, by identifying these cycles, the DPO helps traders spot potential market reversal points when prices deviate significantly from their historical average. In practical trading, the DPO helps identify when prices are above or below their historical average over a specific look-back period. When prices are significantly above their historical average, the DPO indicates potentially overbought conditions, suggesting a bearish reversal may occur. Conversely, when prices are significantly below their historical average, the DPO indicates potentially oversold conditions, suggesting a bullish reversal may occur. To calculate the Detrended Price Oscillator, we need to follow a specific process that removes the trend component from price data. The calculation involves four main steps. Let's walk through an example using a 20-day cycle. Here's a price chart showing both trend and cyclical components. Step 2. We calculate a 20-day simple moving average to capture the trend component. Step 3. We shift this SMA backward by a specific number of days. For a 20-day cycle, we shift by 20 divided by 2 plus 1, which equals 11 days. So we look back 11 days from our current position to find the corresponding SMA value. Step 4. We subtract this shifted SMA value from the current closing price. The resulting Detrended Price Oscillator shows the cyclical component of price movement without the trend. The DPO helps traders by isolating and highlighting the cyclical price components. Remember these key points when calculating the Detrended Price Oscillator for your analysis. Now let's examine how to interpret the signals generated by the Detrended Price Oscillator. The foundation of interpreting the DPO is understanding that it oscillates around a zero line. This zero line represents the point where current prices match the displaced moving average. When we look at a price chart and its corresponding DPO indicator, we can see how the oscillator moves above and below the zero line as prices fluctuate. When the DPO is above the zero line, it indicates that prices are higher than the displaced moving average. This suggests potential overbought conditions in the market. When the DPO reaches extreme values above zero and begins to turn down, it often signals a potential price reversal to the downside. Conversely, when the DPO is below the zero line, it shows that prices are lower than the displaced moving average. This indicates potential oversold conditions. When the DPO reaches extreme values below zero and begins to turn up, it may signal a potential price reversal to the upside. The further the DPO moves from the zero line, the more significant the deviation from the historical average. These extreme values typically indicate stronger potential reversal opportunities, as the price has deviated significantly from its historical norm. Traders look for these extreme DPO readings as potential entry or exit signals, especially when they start moving back toward the zero line.
Let's compare the Detrended Price Oscillator with other popular indicators like RSI and MACD to understand their fundamental differences. While many technical indicators track market momentum, the DPO stands apart by specifically isolating price cycles. The Detrended Price Oscillator completely removes the trend component from price data, allowing traders to focus purely on cyclical movements. In contrast, the Relative Strength Index, or RSI, measures the speed and magnitude of price changes, focusing on momentum rather than cycles. The Moving Average Convergence Divergence, or MACD, tracks the relationship between two moving averages of the price, which also focuses on momentum and trend strength. The unique value of the DPO comes from its ability to remove the trend component entirely, helping traders identify potential turning points in the market without trend interference. When choosing which oscillator to use, it's important to understand their different purposes and strengths. The DPO excels at identifying market cycles and periodicities because it completely removes the trend component. The RSI is better for spotting overbought and oversold conditions based on the speed of price changes. And the MACD helps confirm momentum and signal potential trend changes by comparing moving averages. Unlike momentum indicators, the DPO's value lies in revealing cyclical patterns that might otherwise be hidden by the overall market trend.
One of the primary uses of the Detrended Price Oscillator is to identify market cycles. By observing the regular oscillations of the DPO indicator, traders can determine the average length of price cycles in a particular security. For example, if the DPO consistently peaks and troughs every 30 days, this suggests a 30-day market cycle. This information helps traders anticipate potential future turning points in the market. By understanding these market cycles, traders can identify optimal entry and exit points, prepare for potential market reversals, and fine-tune their timing for other technical strategies. The Detrended Price Oscillator has several practical applications across different markets. The DPO works exceptionally well in markets that exhibit cyclical behavior. In commodity markets, the DPO helps identify cyclical price movements that occur regularly. Here we see gold prices demonstrating clear cycles over a 100-day period. When we apply a 21-day DPO to this commodity data, we can clearly see the regular cycles around the zero line, helping traders anticipate price reversals. Notice how these cycles repeat approximately every 20 to 25 days, giving traders a clear time frame for potential trade planning. The DPO can be applied to various time frames, making it versatile for different trading styles. Day traders might use a shorter DPO period on intraday charts to identify short-term cycles, typically looking at 5 to 15-minute charts with DPO periods between 10 and 20. Swing traders often apply DPO to daily charts to capture multi-day price movements, with periods typically between 20 and 30. Investors might use longer periods on weekly charts to identify major market cycles, often using 20 to 40 periods to spot longer-term trends. To maximize the effectiveness of the DPO, traders should follow several best practices. First, combine the DPO with other technical indicators to confirm signals. Second, maintain consistent period settings across your analysis to avoid conflicting signals. Third, always confirm DPO signals with actual price action before taking trades. Fourth, consider adjusting your DPO period based on current market volatility. And fifth, use the DPO in conjunction with key support and resistance levels for optimal trade entries and exits. Let's look at a straightforward step-by-step approach for applying the DPO in real trading. After selecting your market and applying the appropriate DPO period, focus on identifying where the DPO crosses the zero line, as these often signal potential trend reversals. Always confirm these signals with supporting evidence like price patterns and volume changes. Finally, execute your trades with proper risk management, setting clear stop losses and profit targets based on the identified market cycles.